On January 30th, 2019, AT&T reported fourth quarter and full year financial results for the period ending December 31st, 2018. This video provides an update on the company's dividend safety using its most recent operating results. To begin, let's talk about AT&T's business model. AT&T is a leading provider of communications and digital entertainment services in the United States and worldwide. The company provides internet access as well as television and wireless services to millions of consumers. AT&T trades on the New York Stock Exchange with a market capitalization above $200 billion. AT&T is one of the world's most popular high-yield dividend growth stocks. The company's current dividend yield is north of 6%. Moreover, AT&T is a consistent dividend grower. In fact, the company has increased its annual dividend payments for 34 consecutive years. This qualifies AT&T to be a member of the Dividend Aristocrats Index, a group of exclusive dividend stocks with 25-plus years of consecutive dividend increases. For the remainder of this video, we will discuss AT&T's dividend safety from four perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss AT&T's dividend safety in the context of the company's current earnings. In the fourth quarter of fiscal 2018, AT&T generated adjusted earnings per share of 86 cents, which compared quite favorably to the 78 cents of adjusted earnings per share in the same period a year ago. For context, AT&T currently pays a quarterly dividend of 50 cents per share, which implies a payout ratio of 58% in the most recent quarter. Looking out over a longer time horizon, our conclusion is the same. AT&T generated $3.52 of adjusted earnings per share in fiscal 2018. The company distributed $2 of common share dividends during the same period for a dividend payout ratio of 57% in the full fiscal year. Using earnings, AT&T's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare AT&T's current dividend payment to its free cash flow. AT&T generated $12.1 billion of cash flow from operating activities in the fourth quarter of fiscal 2018 and spent $4.1 billion of capital expenditures during the same time period, for a free cash flow of $8.0 billion. The company distributed $3.6 billion of common share dividends during the same time period, for a free cash flow dividend payout ratio of 45%. Looking out over a longer time horizon, our conclusion is the same. AT&T generated $43.6 billion of cash flow from operating activities in fiscal 2018 and spent $20.8 billion on capital expenditures for free cash flow of $22.8 billion. The company distributed $13.4 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 64%. Using free cash flow, our conclusion for AT&T's dividend safety is the same as when we used earnings. The company's dividend is currently well covered by free cash flow, and we see no risk of a dividend cut in the near future. Companies do not cut their dividends in good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze AT&T's current dividend safety in the context of the company's historical recession performance. We believe the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. AT&T's performance during this time period is shown here. AT&T's earnings per share declined by 22% peak to trough in the worst of the 2007-2009 financial crisis. With that said, the company's earnings still covered its dividend payment, and it continued its multi-decade streak of dividend increases. Because of this, we have little concerns about its ability to pay rising dividends during financial economic downturns. The last angle we will use to assess AT&T's current dividend safety is by looking at the company's current debt level, which is a cause of concern for many investors. More specifically, we will see how much the company's weighted average interest would have to increase before its free cash flow would no longer cover its dividend payment. At the end of fiscal 2018, AT&T had $176.5 billion of total debt outstanding. The company generated $2.1 billion in interest expense in the most recent quarter for a weighted average interest rate of 4.8%. The following image shows how changes to AT&T's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As you can see, AT&T's weighted average interest rate would need to rise to above the 10% level before its dividend would no longer be covered by free cash flow. Because of this, we have little concerns about the impact of the company's debt on AT&T's dividend safety moving forward. Thank you for watching today's video, which performed a deep dive on AT&T's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.